In this video, we're going to discuss volatility. Why? Because volatility gives us short-term traders some amazing trading opportunities. Before we understand how to not only stay safe in volatile markets, we definitely have to learn to take advantage of these awesome opportunities and outsized gains. But before we can take advantage of this volatility, we must understand exactly what volatility is. So let's go over to our friends here at Investopedia and take their definition. It's actually a measure of dispersion around the mean or average of a security. Volatility can be measured using standard deviation signals. Why not? The more it's away from the mean or the less below the mean, that gives you your volatility. And what do we use to look at something like this? We use the VIX, a CBOE measure, the VIX index. Simply put, the VIX is a measure of calls and puts, future dated, put into one index, and it measures the volatility, the price changes of a security. The higher the VIX gets, the more volatile these names, and it tends to rip up during bear markets. Check out that chart. As you can see, volatility extends to highs as market reaches lows. You could see in August, we got that bump up on the S&P, and look where volatility went. VIX was down near the bottoms. What you want to do is buy stock when the volatility spikes and sell when it's low. Can we use volatility intraday? The answer, simply put, yes. The most important thing is backtesting. Make sure, just like any strategy, that the equity or whatever you're looking at does have a correlation with the VIX. One of the safest plays are looking at the indexes. When you get a spike up, that could be a great time to leg in to some of those positions. So let's have a look at this chart. It compares the S&P 500 with the VIX daily charts, both on daily charts. You can see here some dispersion between the two. When the market rallies, the VIX goes down and vice versa. Very important that you understand this. In fact, this chart is absolutely perfect because it does show that the biggest drawdown days in the market coincides with those VIX spikes. Now, as short-term traders, we have to understand that's what we're looking for. We're looking for volatility. So when we see the VIX moving around, those are perfect days for us to get in there, possibly use more risk, put on some more shares, and watch out for key levels, because spiking or moving down is very, very important for day traders. You need to know when the market is volatile. Now, when you add this very, very simple strategy of waiting for VIX to move, looking for volatility, you will not only be more successful as an intraday short-term trader, but it does give you great opportunities to take advantage of long-term dollar cost averaging. Do it on indexes when volatility spikes. Just look at the last 2 weeks as an example. The market is rallying and the VIX is heading to the downside. So as the market starts to rally, VIX becomes less important as those elevated levels come back down to a more comfortable base. Take more risk on days when volatility is heightened. When volatility is lower, it's a great strategy to pick up more shares in your longer term account because, hey, it's spiking for a reason. The market is volatile. You want a dollar cost average long term and get aggressive short term. Make sure to scan our QR code and grab our free daily watch list with all the hot stocks, and tune in every single day, 8:30, TraderTV.Live.